We have been chatting to Teybridge Capital for a little while now, but we're joined by Colm today, who's the CSO, if I'm correct.
Correct, Pearl.
Amazing.
Nice to meet everyone.
Lovely to meet you. So we've got a nice little crowd of our members here today, but it is also recorded, and I'll pop this up in a little blog format as well for the rest of the community that can't make it. But I will hand it over to you to introduce yourself and walk us through what you're doing at Teybridge.
Great. Yep. No, thanks everyone. Appreciate the time. And I'm just going to run through a quick presentation today. But in terms of myself, I'm Colm Devine. I'm the CSO of Teybridge Capital Europe. We are a supply chain finance provider with offices in Dublin, London, and Cape Town, providing a variety of working capital products to clients globally across a number of areas, and we'll touch on those within the presentation. But just going to share the screen quickly and give a very brief presentation, and we will leave plenty of time at the end for questions on some of the matters we're going to cover now. But bear with me one sec. Let me know if everyone can see that.
Yep, can see that. That's good on our end.
Sec now. Just go to PowerPoint Live. Okay, perfect. So, firstly, as I mentioned, thanks for the opportunity to present here. And what we're going to look through today is a practical session for fractional finance leaders. And the objective is not to catalog every product available out there, but to help identify the cash conversion problem and match to the right capital and prepare a fundable proposition as a result. So obviously it's working through the working capital solutions that are available to clients out there. We deal with companies from startups right up to corporate, so a broad range of clients come to us with different requirements and different questions. Some of those have different funders behind them, so whether it's VCs, whether it's debt, and whether it's just pure startup and self-backed, we've come across a lot of different companies. So obviously just giving our perspective on this, so feel free to ask questions as we go through. In essence, then, what we're looking through on today's route map is the landscape. So what has changed out there, what we're seeing at the moment, obviously identifying that funding gap and how we can look at solving the capital problem. Some of the solutions that we see out there, so we've kind of 4 working capital solutions within our stack that has helped companies. And obviously it's around the fundability. So what people are people need to assess when they're looking at this. And finally, some action points. So what CFOs can do now. But the core idea behind this, and always the aim that we focus on, is the aim is to use the cheapest, most flexible capital that matches the cash flow event that a client is facing at any given time. So when looking at the current funding landscape ourselves, we often hear our clients say that they're struggling to actually get access to funding. But the fact is that the market is not simply open or closed. It can just be that they're looking in the wrong product for the wrong product in the wrong place at the wrong time. And that can be as a result of the market becoming much more segmented over the last 10 years. So there's a lot more options out there that people need to sift through to find the right options. But looking at some interesting statistics from the British Business Bank data, it shows that fewer smaller businesses were using external finance over the past few years, and that includes the likes of debt and equity, while at the same time gross bank lending increased, which is a bit of a misnomer. But the interesting point about the increase in that is that the challenger banks are now representing 60% of total bank lending, and that's showing the scale of change that happened within the market. So there are a lot more players in there, but at the same time equity investors have become much more selective over that period, and the implication is that the preparation and product fit matter more than ever with an SME is seeking any kind of form of finance. So as you can see from the slide, funding is available, but access to more selective, and the market is more fragmented. So we've seen that there is more choice out there. So there's more specialist lenders, there's more challenger banks, and they're becoming more active within here. And this has become a much more dramatic shift in the lending landscape. But on the flip side of that, there is more selectivity. So a lot of the lenders out there are becoming more selective in who they will work with. And just to give an example, the likes of equity deals fell 24% year on year since 2024, even as the the aggregate value improved. So there is a move away from the high volume of deals to a focus on backing the deals with the highest chance of success. And that kind of does filter down to other lenders in the market. So we do become more selective ourselves and backing the right companies, which we think we can help scale. And then one of the main issues that companies are facing at the moment is there is more complexity in the market. So there's more products out there. So there's a focus on product, collateral, debtor quality, transaction structure, and these increasingly determine the access to funding. So the range of products available has increased. So an SME must spend much more time looking through the different options out there. So it is a bit of a minefield for them. And obviously a good CFO can help guide them in the right direction. So what does that mean kind of for finance leaders? And we're often approached with companies looking for a product. So saying that they need a certain product, but when we review it, it's not actually the product they need. And we try and point them in the right direction. So don't start with a product. It's almost starting with the cash conversion cycle is often one of our key aims when we talk to a company. And we try and provide them with some of that guidance to say, this is actually what you need to be looking at. Secondly, then it's expect stronger evidence, cleaner data, and a defined repayment source. Again, companies come to us looking for funding, but haven't really thought through the evidence they need to provide to us to get that funding and what the repayment cycle is, which is a key element of this discussion, which I'll come to later. And obviously then there is the option for a blended capital stack. Again, a lot of companies will just go to one provider and try and get the funding there. We work with a number of different partners. So that could be banks, it could be venture debt companies, etc., to provide a blended capital stack, which we feel is the important part for any company. Then in terms of the funding gap, so the common mistake we see with SMEs is obviously using kind of permanent or medium-term capital for a short duration cash time problem, which is obviously not a good solution. So working capital finance can sit alongside bank debt, venture debt and equity, where there is a clear transaction and repayment event. And it is highly complementary capital, so not automatically a substitute for all other funding. And as you can see from this slide, the best uses for these different types of funding as each solve different problems. As you can see, when you're looking at bank debt, it's obviously lower cost, but there is lower tolerance here. So it's best for predictable cash flow, usually has to have track record and is security led, but there is covenants and amortization as a key feature here. Whereas venture debt has a very different view. So they're looking at runway expectations, but it's best for equity back scale ups, can heavily rely on sponsor support and needs runway. And there is usually warrants, covenants, and refinancing risk to the fore. But then in terms of equity, it can be best for obviously product, team, and market build and absorbs uncertainty and losses, but it is an expensive form of finance. And we've seen a lot of companies simply dip into equity rather than looking at the different options out there to give them greater runway. And we'll obviously talk through an example of that shortly. But what working capital does is fit around that and fills those timing gaps. So we have stepped in at different times to work with many of the providers across this scale to provide some working capital. And there's various companies like us out there at the moment who do plug those working capital gaps. So it's obviously trying to review all options before they dip into a particular element here, because they can find themselves constrained by taking on particular bank debt, which may have a charge over all assets of the business, which then will result in, for example, us not being able to help with certain elements or other funders not being able to help with certain elements. So it's reviewing all in totality at the outset. Then in terms of some of the tools that are out there, so there are obviously 4 tools that we have within our product stack, but that's not to say it's an exhaustive list. But these are areas where companies can work with us and other providers to plug some of those short-term gaps. And everything we do is short-term in nature. So receivables finance, extremely straightforward. It's basically unlocking the cash tied up in the receivables. We often work with companies on purchase order finance ahead of those receivables where there are strong debtors. That allows them to free up that cash earlier, put that back into the business, get access to favorable terms from suppliers, etc. And then another element is supplier finance. So this is simply where we can pay suppliers up front and give our clients extended terms. That allows them to get goods in, sold, and generate cash, and then repeat the cycle. And then often we have a lot of clients sitting with a large level of inventory, and we have inventory finance, which can free up cash that they've already invested into that and use it for other areas. And what we see in the market is that sometimes people are using a variety of these to actually achieve their goals at different times within that product cycle. Then obviously the key challenge here is choosing the right solution for the SME. And we put together a handy matrix to assist with the identification process, because we always try to avoid forcing a product onto a general cash requirement. We always try and make sure it's the right fit. So it's important to ask what has happened operationally, what asset now exists within the business, who ultimately pays for that, and when that payment occurs, and what controls can be established around it. And the strongest facilities are obviously self-liquidating and can be monitored using evidence generated obviously in the normal course of trade. So obviously, as you can see here, just on this matrix, for the delivered undisputed invoices, receivables is obviously the main product. Is there a confirmed order from a strong buyer? You can look at purchase order finance. Is the immediate need to pay a supplier? Then supplier finance or PO finance can be used. Is cash tied up in identifiable saleable stock? Again, inventory can be used. And is repayment visible within the trade cycle? This would apply to any of the products offered here. So obviously companies can look at a variety of all of those at different times throughout their journey. In terms of what lenders look for, so lenders assess both the company and the transaction. Obviously, a strong finance leader can materially improve the outcome by presenting a kind of defined use of funds, a credible repayment route, historical evidence of trading, a base case and downside forecast, and the operational controls needed to protect the funded asset, which is very important from our perspective. But the quality of information from the business can create a lot of confidence for ourselves, because lenders are now putting a lot more emphasis on the quality of the finance team they're dealing with, because we deal with a lot of businesses who know know how to sell, but they know obviously how to manage a funder's money, which is the key element that we look at. So a strong opportunity is a credible story supported by verifiable evidence. And as you can see here from our kind of tick box of the 6 main areas we'd look at, number 1 and highlighted in red is the repayment cycle. So obviously, how are we going to get our money back is the key element. And if that's very clearly explained, you're on a very good track to actually receiving finance that can assist that business. So that's the number 1 thing that we'll always look at, is has that been thought through? Then obviously the previous performance is highly important. Might not always be available if a company is a startup, but if there is trading history there that we can look at, that's a big tick box on our side. The counterparties is extremely important. So when we're looking at an opportunity, it's that supply chain that we review. It's who are their debtors, who are their suppliers, are there high levels of returns, etc. So it's reviewing that to make sure that's extremely robust and strong, and that gives us a lot of confidence. But then obviously having the right controls in place around all of that, so evidence, verification, reporting, etc., is critical from our perspective. And as I touched upon, management team is becoming a very big focus for a lot of people. It's can that management team actually look at a facility, manage it, and do the right things for that we need as a lender. And then finally, the structure, which is more important from our perspective. It's how can we structure a facility that still works for a client. Now, businesses do get declined, but the key point I'd like to make here is decline is not always a judgment that the business is bad. It may mean the proposed structure doesn't control the relevant risks, the evidence we've been provided isn't complete, or the timing is just wrong at that particular time. So we always encourage finance leaders to surface weaknesses before the lender does, and propose mitigants rather than holding complexity back, because most credit concerns can be anticipated. So it's always saying that this is the issue, but we are going to deal with it in the following way, because that's exactly how we present something to our credit team, to say there are issues within this, but this is how they're managed. And obviously, as you can see here, we've given a list of some of the areas. So for the client, so weak or unclear repayment source. So you can then show transaction level, cash conversion, and downside timing, etc. Obviously, poor management information is a key one. So what can be done there, produce more accurate management information and a 13-week cash flow cycle, which can be shared with a lender. Customer supplier concentration, so not evident, not so much an issue for a lender like ourselves, but sometimes you want to see that there is thought process put into what will happen with that concentration risk. Then obviously disputes, dilutions, or aging. These are things that can be looked at ahead of time and say, this is the reason for them and this is how we're going to clean them up. Over optimistic forecasts. I think every one of us has dealt with people who've put those in place, but it's obviously giving some context around why they think they're realistic. That could be based on, emails for future orders that they think they may receive, which is still valuable, but obviously not concrete. And then obviously existing security restrictions, it's how you can deal with that. If there are existing lenders in place, are those lenders willing to work with other partners? So say, for example, we have partnered with many banks who might have charged us over the entire business. We might want to fund an element. So whether that's stock, whether that's receivables, it's working with those lenders to say, well, actually, can we get a carve out for a particular segment? They retain all other securities, but the company's in a much better position to actually move forward. So it does allow a company to actually access other levels of cash. And I did mention a company case study here. So this is an example of a company that we have dealt with that grew rapidly, and they had a very good idea. They were equity backed, and they felt that they could solve the last mile cycle in the courier space, invested heavily into technology, so heavily loss making at the outset, but considerable cash burn. They were obviously getting paid by debtors up to 90 days, and they were having to pay drivers, depot, etc. on a weekly basis. So considerable cash burn. So they had two options. One was to go back to the equity investor and ask for considerably more money to actually allow them to get to where they need to. Or the other option was to actually work with a provider like ourselves, where we could provide a selective invoice finance facility against those good quality debtors, give them the cash up front and allow them to grow strongly. And what we had to get from the investor then was a carve out of the debtor book, which they gave us, because it obviously meant that they didn't need to put additional capital into the business. And we scaled this business from a 2.5 million facility to a 15 million facility. But in essence, they went from a 500,000 turnover when we first met them to 100 million turnover in a short space of time, based on having the right facility in place. During that period, then they engaged with one of the main banks and managed to put in a debt line again with us, included in the discussions to make sure we kept in place. So in essence, what they managed to achieve through all of that is that equity funded the strategy, receivables finance funded the timing gap, and term debt then supercharged the growth of the business. So they're now on to a track to potentially enter the US market and go from 100 million to 1 billion. So it's just an evident story of that using the right funding at the right time can actually help a business, because they could have ended up with considerable cash burn by taking equity investment and putting it into that working capital cycle. And obviously then just in terms of where working capital creates value. So working capital finance creates most value where growth is real, margins are sufficient, and the funding revolves through a definable trade cycle. So it's not a cure for structural losses, an unproven business model, or a permanently undercapitalized balance sheet. In those cases, obviously there are other tools out there like equity or restructuring or a broader turnaround plan that's needed. Working capital has a strong fit where growth is visible in orders, invoices or inventory terms, gross margin comfortably absorbs funding cost, repayment occurs within a defined trade cycle, and debtors and suppliers are established and verifiable, and management information supports ongoing monitoring. And obviously where it doesn't fit is funding is needed to cover structural losses or overdue taxes, no identifiable asset or a payment event, margins are too thin, or collections are highly disputed, inventory is obsolete, and forecasts depend on unconfirmed orders. Then I've actually recently worked with a CFO on a plan and a transaction where they outlined that they work on a kind of 30-day fundability plan. I'm sure you all have your own approaches, but obviously I just thought I'd add this in as the last slide. So during that period, their aim was always to try and explain the cash conversion cycle, quantify the funding requirement, produce kind of lender ready information, and identify the risks and approaches and providers whose product matches the transaction. So obviously the objective is not simply more debt, it's obviously getting the right product at the right time. So as you can see here, they went through the process of week one doing diagnosis of the issue. Week two was preparing plans around things like cash flows.
That's just me.
No, I think he froze.
Apologies, sorry. I seem to have dropped off there. Can you hear me?
Yeah, you're back.
Apologies.
I think you Colm, I think you froze there. I think you were offering us all a major discount when you were coming
Absolutely, Stephen. Apologies now. This is the last slide anyway, so I'll just cover off. So obviously what we're looking at here is, you know, the business is obviously getting the right product at the right time. So as you can see here, they went through the process of week one doing diagnosis of the issue. Week two was preparing plans around things like cash flows. Obviously what we're looking at here is The key for us is a lender-ready story with evidence, headroom, and a clear repayment plan. That's what we look for in our world, and I think that kind of translates across the board. Just to finish off then, happy to pause for any questions, but that was just a brief run through of where working capital sits for SMEs alongside some of the other products that we work with out there.
Colm, just in terms of funding, how do you reach outside the UK in geographies? So I don't mean export revenue. I actually mean, entity-based income and funding, say in the USA, direct.
Yeah, so we cover a number of markets, Stephen. So we have a lot of clients in the US. So I think we're in Australia, Singapore, Hong Kong, Netherlands, etc. So we have a pretty broad reach. So Africa as well. So part of our shareholders are African based. So we have pretty broad coverage ourselves. And a lot of the time we actually work with, say, UK based companies that might have subsidiaries in those markets because we see that as a big trade route for ourselves.
Okay, no, thanks. Because often I see the funding is export income and particularly talking about receivables funding. I often work in staffing businesses, which is a sweet spot for you guys, assuming the debt ledger is fine. But and I find that often the UK companies aren't able to do it. HSBC used to, but then they sold their US arm. That didn't help, and lands up going with very outdated US-based funders like eCapital, Advanced Capital, that kind of stuff, which I'm surprised how backward they are.
Yeah. No, we, for example, we would have one company in the recruitment space, and I think we're in 11 different countries with them at the moment, including the US. So, and it includes Netherlands, Germany, etc., Sweden. So we can cover different jurisdictions, which is one of the strings to our bow.
Very cool. All right, sounds good. I'll send you a LinkedIn invite, by the way, to talk about it.
Great. Thanks, Stephen. Anyone any other questions or anything you'd like me to cover off? Nope.
I'm curious, with the CFOs that you work with, where do you often see them misjudge the right funding options for clients? I'm curious about early mistakes and how we can think about avoiding them or at least being aware.
Unfortunately, sometimes we start checking the CFOs when they've already made the mistake, Pearl, is the honest answer. Sometimes they'll come to us, they've already put the term debt in place or they've already, agreed to put in additional equity, etc. But usually we're trying to get to them before that point where they do sometimes come from a certain product. And that's usually the case. They might come in and say, we need purchase order finance or they need stock finance, etc. And we'll do an assessment with them then to establish, well, based on your current trajectory, this is what we think you need. Often what we will do is where we can't find a product, we'll work with another partner within our network and pass them on to them as well. So it's usually trying to give them good advice. The team in here are highly experienced. So some people who've acted as CFOs themselves, and they obviously can lend additional advice as well, Pearl.
Yeah, amazing. And besides getting in touch with the likes of Teybridge, what can CFOs do earlier in the process to make it all a bit smoother, would you say? What are some, I guess, pointers that you'd give?
Well, I think based on what we were looking at there, the key element is understanding where that cash flow gap is at at a certain point in time. There are a whole host of different companies out there adding value at different times with different products. So I suppose it's understanding what is in the market, because a lot of the time people will simply go to their local bank or whoever they're comfortable with and chat to them rather than reviewing the full market and seeing what else is out there. So that would be one recommendation, is to understand the market and then also understand what the actual problem is.
Amazing, thank you. Any other questions from the group?
Yeah, I've just got one question if I can. It's Charlie here.
Charlie.
For a startup which is pre-revenue, is that not really in your space, and where would they go for that? Is it more just venture capital?
Yeah, if it's pre-revenue, we only kind of step in when they have revenue or even contracts. We have worked with kind of companies who have won their first contract. We advance funds against that contract, but that's kind of few and far between. Normally, it is kind of the venture debt route, and we do have a large stable of venture debt companies we work with ourselves, Charlie. So, one of my colleagues, Clive, who's actually meant to be joining as well, is highly experienced in that space. So, if you did want some steer on some of the best ones out there, depending on the sector, we're always very helpful or happy to point you in the right direction.
Thanks. Yeah, I've also just connected with you with LinkedIn, so you'll see my invite. Thanks.
Great. Cheers, Charlie. No, we can help there.
We've got a question from Lewin in the chat as well. Do you see yourselves as just a bridge to conventional bank lending, or are there businesses where working capital finance remains the better solution even after they become bankable?
Yeah, so it's probably both. So a lot of the time companies may feel that there's a bridge to conventional banking, but some of our larger clients have managed to stay with us because simply when they've gone to the bank, the facility offered wasn't fit for purpose. It may have been cheaper, but it wasn't giving the flexibility they needed. And to Stephen's point earlier, that could be because they need to cover 4 different jurisdictions. And HSBC might say, well, we're only going to do your UK business, for example. So we always run the risk that companies move on. Everything we do is kind of selective, which means companies can leave when they need to. But that does mean that we find that companies stay with us longer, which is strange because they'll say, well, actually, it's not something I'm tied into. So they continue using it until they see a better fit elsewhere. But a lot of the time, yeah, our cost of capital is obviously much higher than the bank as you'd expect, which means that eventually companies may decide to move on to a more conventional offering. That answers the question.
Yeah, that answers the question. I had a bit of a follow-up on that. Do you charge any sort of upfront setup costs for this?
Yeah, so we usually charge a facility fee at the outset, which is a one-off on the setup. It's only charged when the company actually draws down, so there's no costs incurred until they actually start to use the facility. But that cost then does cover everything we've done in terms of that initial setup. So we obviously do have to register a client on our portal. We have to do a credit paper, etc., etc. So all of that needs to be covered. So we do just do that as a one-off. But then after that, Lewin, it's a pay-as-you-go model.
Okay, thank you.
All right, any last questions? Stephen Owen, you're awfully quiet over there.
I suppose just generally, do you normally find that most of your clients only sort of engage with you when they hit cash flow issues, or are there other scenarios that I'm missing? Because I can imagine it's mainly that drives it, but am I pigeonholing it a little bit too much?
A lot of the time, the first action that clients have is, when there's a cash flow issue, they'll come to us. We do have companies who are a bit more forward thinking and will put solutions in place a long way ahead of time. So we have companies that we might set up, but they mightn't come back to us for 6-12 months because they've actually considered that they may need a purchase order finance or an inventory finance or a receivables finance down the tracks. So they'll have that ready because it is an on-call facility that a lot of companies like to have there that they can draw down when they need it. So we do prefer actually when companies come to us well ahead of time. We don't like the people who've come and say they need to make payroll next week. That's not really what we want to be focusing on. We want to actually have a company who stays with us for the long term and we grow with them and add additional facilities as they grow.
Okay, so if you had an on-call facility, would you just incur the setup cost, or would there be like just say you stayed annually? Would there be a repeat fee associated with that?
Yeah, so they would only incur that first cost if they draw down on the facility. So obviously if it's in the background, they haven't incurred any costs for having it on standby. It's only when they first use it. And then sometimes we do have annual renewal fees, but they're at a much lower level than the initial setup. So that's obviously just to cover the cost of, say, a re-KYC and AML from the team, or doing another credit underwrite to make sure the facility is current.
Right. Okay, thanks.
Amazing. Over to you, Lek.
Hi, very interesting presentation. Thank you. The question I've got is, do you provide funding to employee ownership trusts transactions?
Yep. So we have done an EOT before. Yep.
Right. Okay.
So only one. So we had to learn what that was, Lek, to be perfectly honest. I wasn't sure what it was until they showed up.
Okay.
I think that's good. I think that's 1.5 years of the UK.
Okay.
All right. Any last questions before we jump off this call?
Pearl, I'll send you on the presentation if you want to share with the team. Yep.
Yeah, absolutely. I'll do that. I'll send along Colm and Clive's LinkedIn's as well, so everyone can connect. And we'll pop up this recording as well for anyone who's missed it. But thank you again, Colm, for joining us. It's a really good presentation. So appreciate learning a bit about Teybridge.
Great. No, thanks for everyone's time and have a great day.
Thank you very much.
Cheers, guys.